All right. Hello, everybody. It is Wednesday. Leon and I are coming to you live from Investing Education Academy. Today, we have a topic that's slightly different than what we normally talk about. We're actually going to talk about life insurance and why you should get it for your kids. Let me see. If you know people with children, if you have children, this is really a good time to share the link. And Leon will tell you why we chose this topic, why I do what I normally do, a little bit of housekeeping.
Yeah, so this is a topic I admittedly knew nothing about before Brent kind of enlightened me to the power of life insurance. So there's a lot of people out here that think of life insurance as it's a scam. It's what people do to try to get over. It really has no true benefit to anybody except for the person selling it. Well, that is so far from the truth. And, Brent always mentions that during COVID, sadly, that over the last year with over 600,000 deaths from COVID, it was one of the largest wealth transfers in the history of the United States. And the reason being, and I was actually kind of confused by that statement when he would make it early on, but now I see why. It's because a lot of these people that passed, I think the majority of the people that passed from COVID were over 65. I think it's like 80% of the deaths, of the 600,000 deaths, were people over 65. And a lot of these people had life insurance. And so this weekend at our Ask the Expert inside our membership platform, Brent went through essentially a class and walked us through life insurance. And it was absolutely eye-opening. It was stunning to me. Prior to this, he had done some things before where I kind of understood, how life insurance worked and the benefits of it. But the one this weekend, so I just said, anyone who's an IAA member, who is a member of the IAA membership platform, please do yourself a favor and go in and watch the Ask an Expert from this past weekend. It's posted there now. You'll see it at the top. It's in the featured box at the top. Go in there and watch that. Give yourself like an hour and definitely watch that because it's eye opening and it literally could be life changing if done correctly. Brent and I was talking about how the stock market is, the way to wealth, the way to earn a lot of money. Life insurance, if the policy is done right, can definitely set anybody up for generational wealth. And like he's saying, if you have kids, definitely have watch this, because I was flabbergasted at how doing this for your kids at a young age, oh my God, sets them up for I don't say it would make them rich, but they can be very well off into their 30s, 40s, and 50s. If you set something up for your kid now, in their sub 10 years old, or even like preteen. So say all that to say, today's what we're about to do right now is not going to be anything like we did over the weekend. This will only be about 20 minutes. That one was actually like a class that went about an hour. But this is definitely something you want to watch. Definitely something, if you have kids, pay attention to. And if you don't have kids, if it's just for yourself or for family members, you definitely want to watch and see the absolute power of life insurance.
Yep. So that was an awesome introduction. Thank
you very much.
So if anybody's listening to the podcast, I'm going to explain as much as I can so you can kind of drive or work out and understand what I'm talking about. But I would suggest for this in particular, you go to our YouTube page and actually see the numbers, because we're going to show real numbers. And, it's a lot of people out there who just have these misbeliefs about life insurance that what everything Leon said, some of that is justified because there are some agents out there who are horrible. And there are some agents out there who have sold subpar products. And when the time comes to utilize what's either owed to you or what you believe is there, you either can't get by on the phone, nobody wants to answer the questions, and you're trying to figure out what's going on with this life insurance. Why do I need life insurance? What's the difference between term and whole life? Like, what's this IUL thing I keep hearing about? What's VULs, what I used to hear about? What is whole life? What's the difference? It's so many questions. And then some people just have the belief that if I start talking about life insurance, I'm going to die. Now, it's true. I've actually had people say that. They're like, I don't want to talk about life insurance because that's like inviting death.
Okay. I mean, hey, everyone has their thing.
Yeah. So like Leon said, we did a class for IA members. It was Saturday, and it was great. It was a great discussion. I mean, we went into the millions, like how to basically become a millionaire in your life insurance policy. And not only how to become a millionaire for you, but we went down to have like 2 generations out to have, I think it was 5 million or more, 2 generations out. And so these are things that you need to know. Now, we do want to say this. We still believe in investing. And, there's certain things that are just undeniable in regards to building wealth. You need life insurance, you need stocks, you do need to save your money somewhere. And we suggest the money that you save, of course, you save it in an income producing asset like stocks or real estate or entrepreneurship. We believe in all of those things. And of course, the new one, cryptocurrency. And now, although it's a derivative of it, NFTs. But we are going to talk about life insurance today, especially for those of you all who have grandkids and those of you all who have children. So I suggest, personally, this is a great time for you to share this information, to share this link with anybody that you know with small children. If you've been curious about how life insurance can work for small children, or if you have grandkids. So let's dive into it. What I'm going to pull up is going to be 2 life insurance policies. And one is going to be for those individuals who have children and they're thinking, okay, I have a extra, or not even, let's say extra. Sometimes you just have to make room for investing. And life insurance is sometimes no difference than investing. You have room for $100 a month. And, with it, you have $100 a month. And we're looking at traditional whole life in this particular situation. And in this policy, it was created 9/4, so just 4 days ago. So this is very new information. With that, you have let's take a look. Open it up. Are you able to see my screen, Leon?
Yeah. Mm-hmm.
Okay. With life insurance, some of us have the belief that it's only good if you die. And before I dive into this, there's 2 types of life insurance policies. Everyone should know this. There's term life insurance and there's whole life insurance. I've done this a lot, and believe it or not, people sometimes don't know the difference. And I'll explain it very quickly. Term life insurance is life insurance that you have for a particular term. That's it. So if somebody comes to you and says, I'm going to help you get a 30-year term life insurance policy, and the person next to him goes, I'm going to help you get mortgage insurance, they're both term life insurance. And I know you're like right now, what? Mortgage insurance is mortgage insurance. What are you talking about, Brent? What does mortgage insurance do? It guarantees that if anything happens to you during the life of your mortgage, the insurance company gets paid in case you what? Die. And so that means it's for a term and it's life insurance. Term life insurance. They just gave it a really fancy name and called it mortgage insurance. Now, and the triggering event, though, is that the beneficiary is actually the bank versus yourself. So it's not in your benefit. And why do banks do that or require it? Because they know how powerful life insurance is. And they know that some of these people, you think about this, banks know that if some of these people who take out mortgages pass away, they don't have enough cash to pay them. And that's why they require mortgage insurance. Mortgage insurance is triggered when you die. Who is the beneficiary? The company that loaned you the money. So why, if banks and all these other institutions know about this, why don't we? Because we don't really have anybody educating us properly on it, right? So Leon and I are. So the other side is whole life insurance. Whole life insurance covers you for what? Your whole life. So if somebody says they have a variable universal life insurance policy, that's just a type of whole life policy. It covers you from age whatever you buy it at to age 100 and beyond. Again, if they come to you with a universal life policy, it's called a UL, that normally, in the most circumstances, will cover you from the time you purchase it to age 100 plus. Therefore, it is whole life insurance. If they come to you with the IUL, Index Universal Life Insurance, that is a buzzword right now, and sometimes it makes me mad. Sometimes it makes perfect sense. It just depends on the situation. But that is insurance that covers you from the age you are now to 100 and beyond. Therefore, it is just whole life insurance. Please don't let people fast talk you into thinking this insurance is magical in some way. It's either term or whole life. Today, we're going to look at a traditional whole life insurance policy with one caveat. It's what we call a limited pay policy. And so in this policy, we're only going to pay the premiums for 12 years. Again, for those of you all who don't know, when agents sell 100 policies, oftentimes they get like an additional bonus, so they get a higher commission. When they sell limited pay, like the one I'm gonna show you, it's a smaller commission. And I'm telling you all this as a licensed life insurance agent. So I'm not throwing anybody under the bus. If I am, I'm included. But also, we're saying that this information is just for informational purposes only. It is not exactly what might be your quote or how much you would pay if you went out to get life insurance for your children. The amounts seen today are based off of, I'll give you the basis. Give me 1 second, let me move this to the side. I believe it's going to be age 4. Now, moving by some of the fine print quickly, because for the purposes of today, it won't matter. But this is based off of a male age 4. So this is a 4-year-old boy. The numbers will be more favorable if it's a girl. Another thing some people don't know, for whatever reason, life insurance, well, actually, I know the reason. I don't know why I said that. Life insurance is normally cheaper for girls than it is for boys. Normally, men do not live as long as women. That's the reason. Additionally, men do not, by and large, take care of themselves as well as women do. That is the reason. All right. So looking at this, it's $100 a month. And you can see it right here. So for anybody listening to the podcast, we're looking at an example of a whole life insurance policy that will only be paid for 12 years. So that means if you have a 4-year-old boy or a 4-year-old child, they will just add 12. So at age 16, you no longer pay into this policy ever again. Whatever age a child is, just add 12 for purposes of this policy. Or looking at, today, you can get 12 pays for most people, actually. I mean, it doesn't have to be children, but in this circumstance, we're just looking at kids. I think is a huge benefit to getting limited pay life insurance, because you don't want to pay life insurance forever, nor do you really want to have as many bills as you don't want to have a lot of bills going into your retirement years. So if you can get a limited pay life insurance policy in any regard that is basically shorter than going beyond age 65, I think that's a win. So if you're 40, you can get a 12-pay life insurance policy, but it might be, depending on the number of amount you're trying to be insured for, the number will be a lot higher than what you're gonna see today, but you can do it. So, all right, let's dive in. So if you're putting $100 a month in, that means you're putting $1,200 a year in. And we're diving down into the meat of it all. All right. Now, again, for anybody who is on the podcast, in this particular situation, if a person said they're going to pay $100 a month for a 4-year-old child, male, they would instantly have a life insurance policy with a death benefit of $112,144. Again, $112,144. Now, why that is important, because if something were to happen, that's the payout. That's the death benefit. So immediately when you drop your first $100 payment, you're instantly covering that child for a death benefit of $112,144. There's no place else that can happen where you can just put $100, pay $100 and then be covered for such a large amount of money, which is why, as Leon stated earlier, as COVID's ravaged the United States, it was the greatest wealth transfer in history. And honestly, it happened pretty quietly. Like, a lot of people didn't know that it was occurring because all these death benefits were being paid out. And of course, if you don't know, death benefits are tax-free. So that's also another point to consider. So now we have your child, they're insured. And I'm gonna skip down, you've been paying $1,200 for 12 years. So when that child hits age 16, if this were a term life insurance policy and you had it for 12 years, when that child turns 16, it would just be over. the policy would have expired, and they would have been insured for 100, whatever the dollar amount is. But when it's done, it's done. It's like car insurance. If you cancel your car insurance, they don't send you money back. With whole life insurance, there's what's called, if you're with a good company, is what's called a guarantee. At the end of the 12 years, you're no longer paying, your child is 16 years old, there's guaranteed to be $11,359 in this account, contractually guaranteed. Life insurance is a contractual, there's a contract between you and the life insurance company. It's normally not related to the market. It's normally not related to, what's happening in the bond world. It's just based off of the ability of the life insurance company to pay you at a given point in time. Now, I keep saying normally in some other statements because it depends on the life insurance company you go with and the type of life insurance you get. So there's some flex room in there, but in most cases, this is how it works. So now, life insurance companies do pay a dividend. Their dividend is based off the performance of the actual life insurance company itself. Therefore, you want to go with a very strong company that pays a good dividend. Also, when you're looking at life insurance and companies that you're buying your life insurance from, you want to make sure that it's not a company that is struggling financially or has a poor rating. You want to go with strong companies that have been in business at least 60 years or more. If you did not know this, when you start looking at how Leon and I talk about the stock market and, buying stock as an investment to make your money grow, life insurance companies are the number one options traders like in existence. Life insurance company, every time you pay a premium, they have money sitting and they invest. They're big loaners of money, even bigger investors in the market, because they know that's where their money's going to get supercharged. And if you can look these things up, life insurance companies really are heavily involved in the options market and stock market as a whole because they're supercharging their money. So even if none of this made sense to you today, why wouldn't you do what some of these life insurance companies are doing? Like when you talk about the Great Depression, life insurance companies pretty much bailed out the United States government. I mean, they wrote checks just to say, look, if you need some money to stay afloat, we'll pay you. We'll give you, loan you some money. They're huge. These companies, they're gigantic. And so when you look at this company paying a dividend, again, you've had the insurance up until age 16, so you've been paying for 12 years. If you receive a dividend, dividends are not guaranteed, but with a company like Mass Mutual, I think they missed like two dividends in 120 years or something. So it's a high probability they will pay a dividend. So now you're talking about having $13,000 in this account. Now, $13,000 isn't super exciting. Depending on who you are, it might be very exciting for you, but you have to think about it like this. You've paid roughly, let's see, I'm going to do the math real quick. Let me just do it here. So you've been paying $1,200 for the last 12 years. And of course, this would be the time. My calculator didn't work, but I can switch.
I could do it.
All right.
12 years. So that's $14,400 at $1,200 per year for 12 years.
All right. So now, again, you're talking about having $13,400 in. That's basically $1,000 less than what you've been paying into this policy for the last 12 years. By the time the child reaches 18, guaranteed amount is $12,162. Guaranteed amount is $14,942. So at this point, you're in pure profit.
Make a distinction with the dividend.
With the dividend. Yeah, with the dividend, you're at a place where you're profitable in this policy. So now that means every year from here on, you're operating in the profit range. So let's skip up. I always like to skip up to milestones. So if something, let's say child's getting married, something's going on, and I never like to look at these as savings accounts ever, but I do look at them as what if you had to break the glass because you had an absolute need. If you had an absolute need at, let's say 26, you're talking about 15,000 being in this account with guaranteed and 22,000 roughly if the dividend continues to be paid out. So again, don't forget, we stopped paying into it at $14,400. Now you're looking at 22,000 sitting in this account, totally unrelated to the market, which means the fluctuations in the market will not affect this policy at all. All right. So then,
I just want to say something real quick. So that's a really good point because one thing that the market one not a problem, but one issue with the market is stocks are generally correlated, right? Even across, so I'm big on saying, invest in different sectors and different stocks. Well, that's true. You should do that because that gives diversification. But when the market, essentially crashes or drops big, all correlations go to one. And what that means is all stocks are generally correlated. So tech stocks, retail stocks, real estate investment trust stocks, they all go down, right? Everything just crashes. But what's cool about this, and that's in pretty big situations. Generally, day-to-day sectors are not correlated, but when things crash, they're generally correlated. Like Brent is saying with life insurance, this is totally uncorrelated from the market. So if there was a crash in the market, say like the COVID crash a year and a half ago, this wouldn't have been affected. The benefit with the dividend would have stayed pretty much right where it is, and wouldn't have seen a drawdown of anywhere from, some people had anywhere from 30 to 80, 90% of their account. So just want to make that point that this is really cool because this is totally uncorrelated from the stock market.
Yeah, and also too, we're talking about doing 100 a month. Many of us can afford 100 a month for our kids, but we just don't think about doing things like this. And so now, again, we're no longer paying into this. I'm going to jump way up to 65. Your child is about to retire, and they're thinking, where's my money? What am I going to do? Covering all this ground. You're now talking about $55,939 guaranteed to be in this account. And again, many of you all who are watching this might be 65. And imagine if even at 65, if somebody said, you know what, I have an extra $56,000 for you, here it is. Or you had an extra $56,000 from a policy your parents took out on you when you were 4, when you were 2, when you were 10, it would affect you. It would matter. It would give you some options in life. Now, let's say this. What if the dividend continued to pay out and you had another 100,000 on top of that? We're talking about 156,000 if the dividend continues to pay out at that point. You stop paying into this policy when it was $14,400. I'm gonna say it again. You stop paying into this policy when it was $14,400. You're now off to your next life. Your kids are 65, and you have effectively left them $156,321. Now, let's say they don't need it. You also were investing for them, which we highly suggest. So the investment account is really where you were building wealth for them that they can immediately use or tap into when necessary. This is break the glass. Hopefully they don't need it. So now time goes on. They're a ripe age of 80. They had a great life. They never needed this thing. It's 81,000 guaranteed to be in this account. 300,000, and you stopped paying when it was $14,400. They don't need it. They move on to their next life. You just left your grandchildren $417,000, and you only paid $14,400.
You talk about passive income. Jeez.
And again, what's going to happen when they receive this is tax-free benefit to them. $417,000
tax-free,
and you stopped when it was $14,400. This is huge. Now let me remember that number. So at 80, it was 81,000 guaranteed. I'm actually gonna write it down. 81K guaranteed with dividend. You're looking at 304,000, and the death benefit is 417K. Now, what happens, Brent, if you were to invest you had a premium of $300 per month for the same child. Let's take a look at that.
And just real quick,
Yep.
where else in the world? So as Brent said, you stopped paying into this when it was $14,400, and it grew to $417,000 when they were 80-something years old. That is a 2,800% return. Where else on this planet can someone get a 2,800% return on anything? So again, this just shows the power. This is what blew my mind. It shows the power of life insurance. And like Brent said, we don't look at it as an investment because it serves the purpose of helping our family out in case someone was to die. But it does have this added benefit of being kind of like a quasi investment, kind of under the table, and can grow huge. Again, that we're showing here 2,800% return over 60 years to somebody.
Yeah. And so now let's say you were like, you know what, that looks great, but what happens if I put $300 in instead of $100? Again, if I put $300 in instead of $100, same age for male. Let's look what happens at age 16. So at age 16, they're guaranteed to have $34,000 in this account. $34,000. And Leon, can you do that calculation? 3,600 times 12.
Yeah.
And while you do that, I'm going to show these kind of as close to side by side as I can.
It's 43,200.
43,200. Okay. So you put in 43,000. There is roughly 34,000 guaranteed to be in this account. With the dividend, you're looking at this account having just shy of $41,000 in it. If you were to call and say, you know what, I don't like anything about this company, I'm not feeling that guy Brent, I just want to stop this, you're going to receive a check somewhere close to $41,000. You put 43,000 in. So that means for the last 12 years, you effectively were paying roughly $100 a year for life insurance. So when you think about it, like how expensive is whole life insurance versus term? Because when you start looking at these numbers and you look at it, from a comparative analysis standpoint, you're talking about $100 a year for, I didn't even say about $300,000 in life insurance. So for the last 12 years, you were effectively paying $100, saying if anything happens to my child, the family will receive $300,000. That's where else can you do that? And now let's talk about what the actual face amount is, or the death benefit is. The death benefit is $404,000, with that supercharging it from $100 to $300 a month. And so let's go back to 100. At 100, you had 11,000 guaranteed to be in the account, and 13,000 as with a dividend, the total cash with the dividend, and 132,000 in death benefit. With 300 a month is 34,000 guaranteed, 40,000 with the dividend, and 404,000 in death benefit. Now you're going to kind of start seeing how numbers really do change. We said 26, they're talking about maybe getting married, something's happening. You stop paying when this thing, 43,000 is how much you put into this account during the duration of your payments. It now has a guaranteed cash value of $47,000. With a dividend, your $43,000 is now coming in $40,000 more at $30,000 more at $73,159. The really crucial part is now you're leaving, if something were to happen to your child, and let's say they're just getting their family started, or they're thinking about starting a family at this point, they're leaving their heirs over $500,000. Over $500,000. You put in $43,000. So we said let's skip up to 65 because there's talking about retirement, the good life's coming. At retirement, can you imagine? Now we talked about let's go back and do kind of an even comparison to kind of see what happens with your money. 65, when we were doing 100 a month, you had 56,000 guaranteed in here. 56,000 guaranteed, roughly 56,000 guaranteed. 156,000 with the dividend. Now let's look what happens when you put, instead of 100, you do 300 a month. At age 65, you're talking about $167,000 being in this account, guaranteed. If they pay a dividend, again, for this purposes, Mass Mutual missed the dividend, like 2 dividends in 120 years. If they continue to pay a dividend, you're talking about a cash accrual of $513,801. You stopped paying when it was $43,000. Now, this is what Leon and I were talking about, multi-generational planning. Your child now has their own family. In this case, his own family. If he were to go out and try to get life insurance for $1 million at age 65, the cost to him would be somewhere, and this is just me guessing from being in the industry, so I'm not running this actual number. Life insurance might cost him somewhere in the area of $7,000 to $12,000 per year if he can even get whole life insurance coverage. Because after you hit 60, life insurance companies get strange about issuing whole life insurance, unless it's a modified policy to people over 60. So you're not only talking about leaving them $1 million, but now they don't have the expense of a $7,000 a month premium for life insurance. That's huge. And you're talking about now you put in 43,000 and you are leaving your grandkids $1,030,054. That's unbelievable. And by and large, we're really not looking at life insurance for our kids. And we're thinking, oh, well, they'll get it when they get older. But what happens when they get older is life hits them. And many of you are watching this realize life isn't exactly what we thought it was going to be. And we start really watching our money pretty tight because we need it. So if they were going to go out and spend $600, $700 a month on life insurance, or they have to choose between that and a car or that and a mortgage on their house, they're probably going to choose the car or the mortgage on their house. Now, what does that choice mean? That means that your grandkids are going to have less than what could have been because we didn't put 100 to the side or 300 a month to the side because we thought, well, they can just do it when they get older. And God forbid any of our children have, a health issue. Something comes up where they have, a growth or something just out of the ordinary happens to them. They can't even get insured. And all of a sudden they cannot get insured. Plus, they're trying to figure out a way to leave money to the heirs while they're spending down the money to take care of their health bills. So let's say in this situation, you're 65, something happened. You ended up in the hospital, just something strange happened. And your kids are like, oh my gosh, mom, dad, something happened to them. Your grandkids, I'm sorry, are looking at mom, dad, which were your children, thinking something happened to them. We don't have the money. You have a living benefit inside of whole life insurance. You can call the company and say how much is in this policy. They'll tell you $513,000. Okay, we're going to need some of that for medical bills for mom and dad. So now what does that mean for your family as a whole? If they pull it out as a loan, not as a withdrawal, that's tax-free. So they're using that money because it's a loan. It's not income. It wasn't withdrawn from the account. It was borrowed from the account. So they have, let's say, $400,000, $300,000 to start paying medical bills for mom and dad because it's there. You put $43,000 in this thing, and you're saving your family from a type of turmoil and mental anguish that most can't even imagine. And in that space, if they were, we went to 80, right? I think in the last example, we went always to age 80.
Yeah.
Okay. In this case, when we get to 80, you're talking about 245,000 guaranteed, 1 million in actual cash in the account with the dividend, although not guaranteed, with the right company, highly probable. We're talking about $1 million on just with the thought that you put in $43,000. And let's again, you don't need it. Life is good for you. You know, your children, they keep it until they pass away. You're talking about leaving $1.3 million to your grandkids or great grandkids, depends on how the situation works out. And you only put 43,000 in. Parents, this is like one of the most powerful things in existence that is underutilized. We can get, and I know the average amount spent on a child for Christmas is like $3,000. Now, I didn't experience that, but just in the US, that's an average. Even if it weren't the average, I know many parents who will go on vacation, they will go to a bar, and they'll spend $100 in a night, and they do it 4 weekends in a row. And they have nothing set up for their kids. Nothing. And, you know, as many of us, we're older, we've experienced a little bit of life, and we know people get sick. Things go wrong that we didn't anticipate. And I'm telling you, it's been so many times, especially with Facebook, you get these GoFundMes from parents who don't have insurance and they pass away, and their kids and the family has no idea how to pay for the funeral. So they start a GoFundMe page because there just wasn't any proper planning done. And
GoFundMe essentially blew up on the backs of exactly what you're saying. Families where people pass away unexpectedly, and the families did not have the money to pay for the funeral expenses. I mean, that's what a lot of, sadly, that's what a lot of GoFundMe is, and that's really what kind of blew GoFundMe up was people mainly met a lot of, at least from what, let me say this, from my experience, it's mainly been medical issues and or deaths in families because again the families didn't have any money or any way to pay for such things.
Yeah, I mean, for the first, I still do it. For Christmas for my daughters and my wife and I, we talked about it, and we asked our family not to get gifts. We asked them to contribute to their investment accounts. Honestly, most of these gifts they play with for like a month. It's really the gift giving oftentimes, and you all check yourself on this. If I'm wrong, please write me a letter. This is Brent saying it, not Leon. A lot of times with gift giving, it's really us trying to make ourselves feel better by being the bearer of all these gifts and getting that quick endorphin hit or dopamine hit by giving the gifts and see the kids light up, because day 2, day 3, they'll play with the boxes. Like they'll play with the boxes, or we buy them all these video games, but they don't own any stock in any of the video games they're playing. You know, I mean, imagine if you did a GoFundMe to fund their life insurance policy. We're talking about, in the first example, $12,000 to leave roughly $500,000 later on. If you can get, or $14,400, if you can get to that place through a GoFundMe, and I've seen GoFundMe go way bigger than that, and you just bought them a life insurance policy, that's gonna, why wait for somebody to die? Do it for your kids. Like, do a GoFundMe and say, I want to buy them life insurance now, when nothing's wrong. And also, one thing you want to think about too is for kids, is guaranteed issue. So they really don't do a heavy medical check for children. And I did one of these, two of these. I did 2 of these last week. And the way we structured it with the families, the children were actually younger than this. Before the kids hit, I think it was 60, they would have over $1 million in their policies. This is before the parents even looked at investments or anything else. Their kids will be millionaires, period. As long as they pay the premium for 12 years, their kids will be millionaires. How many of you all?
And as much as we love the stock market and we live it daily, we cannot say with any certainty at all that investing will make you a millionaire over any stretch of life. But we can say with high probability and certainty that, as Brent said, that situation Brent just gave, that kid will be a millionaire by 60. And you cannot say that in the stock market. We love the stock market. This is why I said this is why I said it was mind blowing what life insurance can do. And again, we don't want to look at it as an investment, because it's really there to help our families in case something unforeseen happens. But the added benefit of it is this sort of investment option that's kind of built in and underneath the surface.
Yeah, and some of us, we're grandparents watching this. Some of us are parents watching this. Watch it again. Go back and watch this with, an aunt, a cousin, sister, a brother, and talk about what you're doing for your kids. Oftentimes people are like, I don't get it. I don't know what it does. This is it. These are the numbers. Go back through this, slow it down, pause it. Look at the numbers.
Take screenshots.
Yeah, the column right here, these are all premium payments, and they all read zero because you're not paying the premium. There's a whole row of zeros. And let's see, I can probably scroll and it still be zeros. It's still a lot of zeros. There's some costs in it. 12 years. You're looking at 12 years. And you can be done. And you can, depending on how you set this up, even if it's $500,000, the issue is this. If you're 30 plus watching this, or you've maybe experienced going out and looking at whole life insurance, and all of a sudden term became so much more attractive because it was so much cheaper. It's cheaper for a reason. Less than 2 or 3% of all term policies ever pay anybody anything. That's why it's cheap. That's why it's inexpensive. Because they know probability of them having to pay anybody is like 97% chance they just keep that money. And because we think, it's less expensive, it makes more sense. Well, if you really were paying the premiums for whole life insurance, at some point, if it's a good company, what's going to happen is the amount of money that you've been paying out is going to be almost equal to the amount of money, probably like between year 20 or 15 to the amount of money that is in the account. And then year 15 and on is where the gap starts to kind of widen, and you have more money actually in the policy than what you paid into it. And that's when things are just beautiful. But in reality, you don't do a GoFundMe when things go wrong. And if you're part of IAA, you can't say you didn't know about life insurance, because honestly, I'd rather you get term than nothing. If you're like, what, I just still can't swing the premium for a whole, cool. But if you would have got it for your kids, they don't have to have this same conversation that we had to have as adults, because our parents never told us about this. Now their thought is, my mom had this for me. And you know what I just realized? I could actually use this as collateral for the first time home purchase or for, any secured loan. Why? Because it's an asset now. There's no payments going into it, and it's 35, 40,000, 100,000, 200,000 sitting in cash. I can use that for a collateralized loan.
Cash, and it's growing.
And it's continuing to grow. Oh, it's a business I wanted to start, but I can't find, no one will loan me money. Well, actually, you can take a loan from your policy for a business. I wouldn't suggest it, but if anything, I would use it as collateral for a loan from a bank or institution, which collateralized loans, if you didn't know, normally have a lower interest rate than a non-collateralized loan, but that's another session. But it's so many benefits to this. And, I said 3, like in the title, it said 3 major benefits. 3 major benefits are you get to like beyond 10 extra money and leave it to your heirs. That's multi-generational planning. Benefit number 2, if done properly, you only have to pay it for a limited number of years. In this case, we're talking 12 years. 12 years. I know people buying shoes at they cost more than these things. And then we have benefit number 3, major benefit number 3. The expense of life insurance the monthly expense of life insurance is either greatly reduced or something your children won't have at all, because you did it for that 12-year period. And now for the rest of their life, they have the peace of mind of knowing they are insured. That's huge.
And then think about it. What are the way? I know of no other way except for this. Now that I know about it, that you can literally guarantee your kids will be a millionaire at some time in their life. And now again, it depends on how much the policy is and how much coverage you have. But again, stock market, love it to death all day long. It's risky, and there are no guarantees with it, as we all know. This does have guarantees built in that you can get it for your kid early enough. Your kid, and again, depending on how much you get, your child can definitely be a millionaire at some point in their life. They can then hand that on to their, your grandkids and then their great grandkids. And this is the one way to build generational wealth that sadly the Black and people of color communities don't ever use, and frankly, really don't even know about, which is the reason why we're doing this today. to try to expose people to this, especially minority communities to this. Because it's like, I mean, again, it's a way to build generational, it's a way to start generational wealth. And if done properly, handled properly, it can be passed down generation to generation.
Yeah. Now, if you have questions about this, you can contact me. You can contact Leon. You can drop a message in the Investing Education Academy Facebook group. Personally, I think everybody should be doing this for their children. I just do, even if it's with the intent of $75 a month, and you just want to get something in place, because I'm telling you, $75 a month eliminates the need for a GoFundMe later on. $75 a month will eliminate the terror that they aren't insured at all when they become adults. And they just realize it someday, and they're like, oh my gosh, I have to figure out how to get insured. These things can be eliminated with education. And that's why Leon and I do these meetings. I mean, it's a lot we can be doing on a Wednesday. We try to educate you all as much as we can. And it's important. It's really important to give back. And we've said it before. I'm going to say it today. Even if you're going to another insurance agent, I'm not saying come to me. Talk to your insurance agent. Show them this video. Or her, show her the video. Just say, is this real? It's conversations we have to have. And also to combine this, if you are used to paying that for 12 years and it stops, keep paying that into an investment account for your kid.
Right. But then open a brokerage account for your kids. Yeah.
After you buy the membership to Investing Education Academy.
Yes, yeah, of course. Because just real quick, you got to think about it. If you have the life insurance growing, one aspect, passive income, and then you're also investing that $100 a month you were putting it towards your life insurance, now growing in a brokerage account, your kids are winning on both ends. I mean, like you said, you're guaranteeing your kids will be a millionaire at some point in their life.
Yeah, and there's so many people talking about like every reason under the sun why they can't, and I get it, but some of those same people I see going on these lavish vacations, I see them like hanging out
in the bar every weekend, spending $20 on drinks and hookah, and food, yeah. And man, again, but nothing wrong with that. I mean, we all gotta live, but it's doing it every weekend versus maybe taking half of that money, putting it towards your kids or even yourself, it can make a difference.
It can make a huge difference. And Leon and I have talked about it before. We plan on doing this for a very long time. The Investing Education Academy is something that we're both committed to. And I mean, the community is growing. We don't want 10 years to go by and we're all grayed out and we're on this thing like doing our Wednesdays count. And people are still saying, well, I don't know how to get started. And I mean, we're happy to still be of use at that point, educating people. But at the same time, if you're watching now, it's a difference between people who, watch it and then they actually do something, and people who watch it and come up with more reasons why they can't, or they think they missed the boat, or my kids are too old now, I can't do it. And those kids end up being the ones doing the GoFundMes later. And you can always
hey, real quick, we're running way late. Real quick, one last story on the thing about being too late. So I recently bought a cryptocurrency, and this cryptocurrency was up, I don't know, it was like 300% like the last 2 months. And yeah, well, no, I wasn't at the time. it was already up big. And I was debating, like, should I get in, should I not? But I was like, you know what? I'm in this thing for till the day I die, or whatever. I'm in for the long term. Why am I even debating this? Like, why am I even concerning where it is, especially with crypto? I got in that bad boy at whatever, I can't remember the price was. Long story short, in 2 days, I was up 84%. 84%. The market's been fluctuating right now. I think today the crypto market dropped big. Today or yesterday, the crypto market dropped big. I'm still up 68% in this particular crypto. And so I'm saying all that to say, you're never too late, right? As long as you give yourself a long enough time horizon, you're never too late. So with crypto, with stocks, with life insurance, never think like, oh, I missed the boat. No, you never miss the boat. As long as your time horizon is long enough, you can always start.
Yeah, and death is the one thing guaranteed.
Yeah.
So why should your family not profit from it? It's not an evil thing to think about. My daughters, they know if something happened to my wife and I, they get $2.7 million. And they know at age 9, they know exactly how much is 2.7. They know what to do with it. They know, they believe they know what to do with it. My oldest, she'll tell you she got a whole plan. But I don't think she's plotting my death. It's like it's cool. It's fine. She knows how much it is, and it's there for her. And I feel great going to sleep or doing anything I got to do and thinking if something happens. Even during COVID, I was like, I don't want to die, but if I do, they're good.
Right.
It wasn't this terror like, oh my gosh, what's going to happen? And truthfully, if if you have a plan for your kids to go to somebody else, I'm really glad that there's somebody out there who's saying, I'm take care of your kids. Let's start there. But if those kids go over to that person with no money trail, that makes their life very hard.
And you're putting a huge burden on the people that are now going to take care of your kids. Like you said, great, there's somebody there to take care of them, but it's a huge, but we all know kids are costly. Kids are kids. Yeah. And to have them now on that burden onto another family with no financial support behind it is rough. It's really rough.
So, I mean, those of you all again who, thinking, oh, well, I'll think about it, I'll consider it. I really think if you are a parent with children, you should have whole life insurance for them. And I don't think you should have policies you pay your whole life. It should be a limited pay. I'm not saying that just because I'm an agent, but you saw the numbers. We have to stop this environment of just being, reliant on charity. We have an ability to plan for ourselves. Let's plan for ourselves. It takes discipline and a little bit of sacrifice, but it can be done. So yeah, I don't want to go way over. I can talk about this stuff forever. I'm very passionate about this. And I think many of us are missing the boat. Is talking about just last year, biggest wealth transfer in U.S. history. I'll ask this question. How many of you all became millionaires last year because your parents left it to you? Think about that. So
or even okay, say it didn't happen, don't want anybody's parents to pass, but if it were to happen, say, soon, would you become a millionaire? Would you be able to cover their expenses? Is there a plan in place, a policy in place to take that burden off of your shoulders? And yeah, like you said, literally become a millionaire. A lot of us, especially a lot of us, probably not.
Yeah. And I'm just gonna say this again. It's a beautiful thing and a blessing that somebody's willing to take your children into their home. If it's a spouse, that's expected. But if it's like a godparent or your parents or your sister, your brother, and there's no money trail with that, that makes their life very difficult. And I mean, I would go as far as to say it's a little bit selfish because now everything about how they live changes because they're trying to really cover what you didn't do. And so just kind of think about that as a parent. I know it's hard. It sounds probably a tad bit rude to say, but it has to be said that way because, something has to kickstart you into going, you know what? Never thought about it like that. Now, he made a good point. It's not that he's trying to be rude, but it's real. Because imagine if somebody just dropped 2 kids off at your house and said, you know what, take care of them for the rest of your life, for the rest of their lives, thank you.
Yeah, it's logic. It's logic. Kids, there's a cost with kids. And then if you're, like I say, blessed if somebody take your kids into their house, but that then, either doubles, triples, quadruples their bills. When if you had a life insurance policy in place, boom, their expenses are basically paid. Now it's just a matter of them being cared for by someone.
Yep. So with that being said, everybody, thanks for sticking with this. It's been awesome. I love sharing this stuff. We are probably going to come back and do one to show you what it looks like for parents and adults. Let's just say adults, because not everybody's parent. So let's say probably next month we'll do another one. And we are becoming more active with the life insurance group inside of IEA. So I believe our last meeting, if it's not there, it'll be there soon, where we actually did the class on it. And this will more than likely drop also into the life insurance group on IEA, in addition to you being able to listen to this podcast. And if you listen to the podcast or you're not a member of IEA's Inside membership, you can go to YouTube, find this video and watch it there and subscribe to our station. So that's everything for me. We're going to give you our stock picks. Leon, how are we giving them the stock picks today?
So we're going to do what we've been doing. We're going to place, so we do 2, but we're going to place 1 inside our Facebook group. So if you want to find that out, go to Facebook and search Investing Education Academy, join the Facebook group. And then we'll post we'll post both picks inside the membership platform. So the Facebook group, you get one. For the members inside the membership platform, we'll get two.
Yep. Everybody, we want to thank you for being with us, and we will see you next Wednesday.